Hi, everybody, and welcome to another market commentary with Lewisburg Investments. I have Mathieu Roy with me, VP of Equities here at Lewisburg Investments. So, Matt, how's it going today?
Great.
Good. So, as we all know, and we might all have all seen in the headlines, there's quite a bit of movement and questions surrounding what's going on in equity markets and investment markets in general. We've had a great year last year, but there's increasing concerns developing around inflation. We have the Russian invasion of Ukraine. So investors have a lot of questions. Can we just dive into how that's impacted equity markets and what the outlook might be for investors going forward?
Yeah, sure. So it was an exceptional year. If you think about where we've been last couple of years, it's impressive the returns that the equity markets have been able to achieve.
Absolutely.
It's starting a little rougher in terms of global equity markets to start off 2022. And the primary reason is inflation. There's been supply chain disruptions, which were prevalent before, in part due to COVID.
Mm-hmm.
And what we have now is the Russian invasion of Ukraine is amplifying a lot of those concerns. So you're creating, if you had concerns as an investor before, this makes it a little worse.
Of course.
But also from a practical standpoint, there's a lot of resources coming from Russia and Ukraine and surrounding countries.
Mm-hmm.
And so the inflation issues we had before are getting compounded, so that you're finding that in the agricultural and food sector, and you're seeing it from an energy price standpoint as well.
Right.
So the big question is, will central banks go too far in trying to rein down inflation? So if you go too far and you reduce economic growth, then you also are reducing corporate earnings,
which in turns,
exactly. So earnings really, that's what you're paying for when you're buying the stock market, or if you're buying companies, you're buying its earnings. So
absolutely,
all of these things are linked, and that explains a little bit the concern that we're seeing in equity markets overall,
right,
to start off the year. One notable exception is Canadian equities.
Yeah.
So Canadian equities are up for the quarter in a tougher tape, almost 4%. And really, it's because the energy and the materials sectors have been stars. The energy sector is up almost 30% in 3 months, and the materials sector is up 20%.
Right.
This may continue. The reasons that they're doing so well are there still. You're seeing a lot of less supply in the market, and still demand, and a lot of disruption with the conflict.
Exactly.
And what we do like is valuations are inexpensive in Canada to begin with. So you're seeing some tailwinds in Canada. In the U.S., it's not quite as rosy. They have participated fully in the first quarter weakness.
Right.
And if you think about the reasons, interest rates have moved up significantly and quickly. This has a more significant impact on what we call long duration stocks.
Yeah.
And that can mean a lot of things, but from a practical standpoint, it's technology companies which may not be that profitable now, but are growing very fast. So investors are investing in these businesses for future profits. Okay. And if interest rates are really high, then you're discounting profits in the future at a higher rate.
That's right.
It has a bigger impact on their valuations.
Absolutely, yeah.
And the U.S. in particular has a more significant exposure to these types of businesses, a little bit like Canada has a lot of exposure to resource companies.
Yeah.
So those sectors were weak. The communications and technology sectors were weak. That explains the weakness that we've seen with U.S. equities in the first quarter.
Yeah.
International equities perform even worse, but the reasons are a little different. So general weakness, just concern about economic growth, but also a lot of the companies in the international equities market are in Europe. They have closer ties to Russia and Ukraine.
Yeah.
And they also have dependence on Russian oil.
Yeah, it's closer to home.
Yeah. So a lot more direct headwinds.
Yeah.
And it's a slower growth jurisdiction to begin with.
Right.
So all of these things combined made for a tough quarter. The valuation isn't very expensive, but there's reasons that historically justify that as well. Secular growth has been lower. That explains a little bit what's been going on in the equity markets in the first quarter.
So that explains a little bit where we've been and what's going on currently. What are we seeing going forward? Where do we see things unfolding, and what do we anticipate as we head into these markets?
Sure. Well, I think the elevated inflation is key for investors, but also key for central banks, and they're focused on bringing that in, which means that monetary conditions are going to get tighter. Debt's going to get more expensive. Projects are going to be more difficult going forward. So it's just going to be tougher to have higher economic growth.
Right. It feel tighter a little bit.
Mm-hmm.
Yeah.
And companies are already dealing with rising costs and supply disruptions. So it's going to be tougher from a top line perspective because you're trying to rein in growth.
Yeah.
And it's going to be tougher from a margin perspective because costs have moved higher as well.
Exactly. Yeah.
So if you think about it, if you're buying equities because you're buying their earnings, growing earnings is going to be generally more difficult.
Mm-hmm.
We feel that that's especially true in the U.S. and from an international standpoint.
Yeah.
For those reasons, we feel that Canada is facing some of those pressures, but also experiencing a lot of tailwinds as well.
Okay.
So I think earnings growth is going to be easier for Canadian equities and the Canadian stock market overall. Right. So we are predicting a little bit that we're going to see a little bit more of the same in terms of where the leadership comes from.
Okay.
I think Canadian equities are in a better position given its sectorial
better
bias.
Balance. Yeah.
Going forward. And Canadian equities are less expensive on a price to earnings basis than U.S. equities.
Okay.
So from our perspective, the way we're positioning clients' portfolios and what we would advocate is slightly defensive with equities. So a client that typically have 60% in equities may want 58, 59.
Yeah.
Take those profits that we've experienced over the past few years. Don't become overly defensive, but not overly greedy as well.
Yeah.
But we're also positioning it to have a clear bias towards Canadian equities.
Okay.
So a clear overweight with Canadian equities.
More pronounced in that arena.
To the detriment of having a little less U.S. and international equities. That's how we foresee the markets playing out, and that's how we're positioning the portfolios going forward.
Makes a lot of sense. Thanks a lot for your time, Matt. Hopefully this was valuable to you. We'll catch you next time. Thanks.